Welcome back. We are now in chapter 10, and in this chapter we'll be discussing about ratio analysis. So ratio analysis is a financial analysis procedure. Okay, it's one of the tools of financial analysis. There are many other tools, right? But the most prominent among them is the ratio analysis. So what ratio analysis basically does it provides a ratio, something divided by something. It's a ratio of two quantities, right? So these two can be any accounting quantities, right? So we have discussed already P&L and balance sheet. So we've seen various measures under these two statements. So under P&L we had various incomes, right? Like sales and other incomes, right? And under expenses we had number of expenses: raw material, right? Power, depreciation, labor, general expenses, right? Taxation, profit after tax is also one of the item in P&L account. So again, in balance sheet we had various other items under liabilities, assets, right? Liabilities we have segregated them under long-term liabilities, short-term liabilities, current assets, non-current assets. So various quantities, right? Some more than 50 items individually we have looked at, right? If you look at all the statements put together. What ratio analysis does is it calculates certain ratios, right? By comparing quantities, right? So at the basic level, it's a ratio between two quantities. For example, say profit after tax. This will get from our P&L account, okay, divided by sales. This is also from the P&L account, okay. So this will give something known as profitability margin, profit margin, okay. So basically that is what a ratio. Ratio is just a comparison, right? It is something divided by something. So what those A and B are, we will see. Theoretically, it can be any two quantities, right? You can take randomly any two figures, right? But that will not make any sense, okay. So there are a certain set of measures that we are going to focus on. So that will be the subject of ratio analysis, the more prominent among them, right? But basically, why do we do ratio analysis, right? So why can't we just use the absolute numbers? For example, just now we said we calculated profit margin like profit after tax by sales. So we have the individual profits, say for example 10 crores. We have the sales amount 500 crores. So we do have the absolute figures. Then why again are we calculating a separate measure, dividing this by this and calculating some 2% margin? Why are we doing this, right? When we have the absolute figures themselves in rupee terms, why are we calculating a new ratio, right? Why are we calculating a new measure? Okay, so there are a couple of reasons for it. The most important reason is comparison, right? For example, if somebody tells you, right, if somebody tells you he's earning every month 1 lakh just from interest, like he's given a loan to his friend, and that friend is paying him interest every month just from interest, he's earning 1 lakh. So you think this is fantastic because the salary normally is 20,000, 30,000 or 40,000, but this person is earning just interest 1 lakh every month because of a loan given to a person. So you think it is great, but then great again is a very subjective term, right? If he told you that actually the amount of loan he has lent to his friend is 10 crores, then you would not feel that great about this 1 lakh. Because 10 crores had he deposited just in a bank fixed deposit at zero risk, right? He would have earned say 7%. That means 70 lakhs per year, and every month around 6 lakhs. So just by depositing in a bank, he's going to earn 6 lakhs, whereas his friend is giving only 1 lakh. So his friend is clearly taking advantage of this person by paying just of paying a very low interest. So the point is absolute figures are misleading, right? Absolute figures are misleading, especially in business context. When we look at the P&L and balance sheet figures on a standalone basis, they are very misleading, right? And now unless we translate them into ratios or at least percentages, right, we cannot make any meaningful inference out of it, right? Percentages is something which you already seen. That is the basic purpose of ratios. Again, as another example, say a company is earning profit of 10 lakhs. So is it good, is it bad, is it okay? We don't know, right? But if we convert that into profit margin, say the company is having a turnover of 100 lakhs. So the profit margin is 10%. Now we can compare this profit margin with other companies operating in this industry, say of the similar size, and then we find out that the competitors are earning a profit margin of 20%. Then we can say this company is not doing that well compared to the peers, right? Because the peers are operating at 20% margin, whereas this company is operating only at 10%. We cannot compare 10 lakhs directly. Say for example, this company is earning profit of 10 lakhs, whereas another company is earning profit of 20 lakhs. Another company is operating at 5 lakhs margin. One company is 1 crore No, we cannot compare them as it is because the turnovers are different. Maybe this company is earning 5 lakhs by doing a turnover of 1000 lakhs. So this is a very low profit company. This company is earning 20 lakhs just by having a turnover of say 50 lakhs. This is a huge margin, 40% margin. Right? So we cannot compare just by the absolute figures. Right? If we convert that into some meaningful, if we can convert that into some ratio or a percentage, we can draw meaningful inferences from it. Right? So theoretically, a ratio is the relationship between any two accounting numbers, right? But then we do not calculate ratios for each and every possible combination of all accounting numbers. We do a selection, the most important terms, and we try to draw some inferences, right? For example, a ratio like non-operating income divided by depreciation. You can do that theoretically. This is also ratio, two accounting terms, but I mean, you're not going to get anything meaningful out of it. So even though it is a ratio is a relationship between any two accounting numbers, so there are a set of commonly used prominent ratios that we're going to use to track the performance of a company. Okay, so these ratios are used by a variety of stakeholders, right? Banks are not just the only people who are going to use the ratio analysis, right? Bankers use ratio analysis to analyze the financial performance of a company, but there are other stakeholders also who use ratio analysis. Okay, creditors, for example, right? Their focus is different. Their focus is not so much on the profitability of a company. Their focus will be more towards the liquidity, whether the company is liquid enough, whether the company has a sound liquidity position, whether it can repay its short-term obligations. Whereas shareholders will be tracking some other ratios. So if you are interested in the share market, you might have heard of terms like PE ratio, right? So there are a separate set of ratios for tracking if you are interested in the market performance of the company in the share market, right? If you are focused on liquidity, there are a set of separate ratios. If you are focused on if you are a long-term lender like term loans, if you are a bank extending term loan to a company, you are interested in a separate set of ratios, say debt equity ratio, okay, or DSCR. So it's based on what actually are you trying to look at. The ratios will be different. So ratios are categorized into different segments, into various categories, depending on the what exactly are you trying to look at. So if you're looking at, if your primary focus is on profit, there are a set of ratios exclusively devoted to profit. If your focus is on the short-term liquidity, then there are a set of ratios like current ratio, right? Quick ratio. At the broad level, we are going to classify ratios under various categories. So before looking at the classification of the various ratios, right? So we are going to look at the various classifications. For example, there are a set of ratios that are focused on the profitability of a company. Then we have ratios that focus on the liquidity. Okay. Then we have something called the solvency. Then we have ratios called turnover ratios. Okay. We have the capital market ratios. So we are going to do this classification shortly. Right. Shortly we are going to do this classification, and under each head we are going to study what are the various ratios. We are going to do that, but before that we'll start with an important ratio. Right. This ratio actually sits above all this. Right. Over all this ratio sits. This ratio is known as the return of investment capital. Unfortunately, this is a ratio not that much in vogue in Indian banking industry. It's very unlikely that you're going to find your bank tracking this ratio. But then, if you look at the global, accounting context, return on investment capital is a very important ratio. So it is a suggestion that when you look at a balance sheet for analysis, it's the first ratio you should calculate. It gives you a broad picture as to what is the overall performance of the company. Based on that, you can follow up with the remaining ratios. So basically, let us assume that you have started your own business. Okay, you have started your own business and you have put in an amount of 10 lakhs as your capital. Your initial capital is 10 lakhs for this business. So after 1 year, what you found out was this business has given you a return of 25,000. So how do you feel, right? You don't feel that great, isn't it? Because you have invested 10 lakhs and you got back only 25,000. Because the benchmark for returns is a bank fixed deposit, because it's of a zero risk or a minimal risk. Especially if it's a public sector bank, there is almost zero risk, because even if something wrong happens with the bank, the government will reimburse somehow. So this, let us say this is a zero risk investment option. So if you had invested this 10 lakh in the bank, you would have got 70,000 in 1 year. Right? Whereas now you got only 25,000. If there is one more point here, this is the risk here is zero in a bank, very low risk. Whereas on a business, right, you took a huge risk for 365 days. This is your own business. You worked very hard, right? At the end of the day, you're getting only 25,000. So there is a mismatch between the risk and reward here. So clearly this return is not good enough for you. Okay, 1 year in the beginning, right? This is a new company. Okay, you can tolerate that sort of a low return. But if you're getting this sort of a return for 3 years or 5 years continuously, this is not a great investment option. So basically you're calculating what is your return, right, against your investment. You have put 10 lakhs into this business, whereas it is earning you only 25,000. So on a similar line, this return on investment capital, return on the invested capital, this will give you a good idea on the overall performance of the company. It gives you what is the return this business is offering to its investors. Now investors here doesn't necessarily mean the promoters, right? You should understand that promoters are just one of the investors, right? So say a project is of 10 crores. A banks usually stipulate a margin of just 25%, right, at the most for a long-term project. So why 2.5 crores is being brought by the promoters, the balance is being brought by outside parties, including banks and some other parties. So in a way, all of these parties are investors. It's not just the promoters whose funds are at stake here, right? Banks have a major part of the major amount at stake. So what this ratio basically calculates is it calculates the return to the entire investing community. It's not just to the promoters. All the people who have invested funds into this company, what is the grand return this business is offering? That is what this ratio will indicate. So if you want to look at the formula, it is like this. Okay. So return on investment capital is profit after tax plus interest times 1 minus T is the tax rate by invested capital. So here invested capital, I told you, it's not just the promoter's capital, it's not just the share capital. So it is the net worth, that is share capital plus reserves and surplus, that is the contribution by the promoters plus your debt holders, right? Plus your debt holders. These debt holders could be both long term and short term. All your debt holders will come. So this is the invested capital. It's net worth plus long term debt plus short term debt. So these are the people who have invested in this company. In a sense, bank, even though it is not a promoter, it has invested funds in this business. So against this investment, what is the return the company has given? So it is not just profit after tax by invested capital. So you might think that the final figure is profit after tax. So you should calculate only profit after tax by invested capital, but that's not correct, right? There is a small technicality here. Maybe it's not relevant at this stage to go deep into it, but I'll give you the basic idea what is happening here. Why are we adding back that term? See that the second term, why are we adding back this interest? Say for example, profit after tax is 10 lakhs. This investing capital is 100. But we are not saying that return on investment capital is 10%. We are saying it's something more than that. We are adding back something, interest into 1 minus T. Why we are doing that? It might not be that relevant to you, the actual derivation. I will brief you, but don't go too deep into it. Okay. At the outset, just try to calculate the ratio based on this formula. Okay. Why are we doing it? If you are interested, I'll tell you very briefly, and then we'll move on to the major part of the ratio analysis, the other ratios. Okay. So what actually is happening here? Take a look at these two companies. Okay. Take a look at these two companies. These two companies are having a profit before interest and tax of 50 lakhs. That is, we have the sales, and then from here we're deducting raw material, power, labor, okay, other manufacturing expenses, depreciation, general expenses, everything we're deducting, and finally we arrived at 50 lakhs for both the companies. Both these companies are operating at the same profit before interest and tax. The only two expenses we have not deducted from this is interest and tax. Right? Once we deduct, we'll get this profit after tax. So we have deducted all expenses except interest and tax, and we have got 50 lakhs for both these companies. Now one of these companies has a loan from a bank and is paying, and it has paid interest of 10 lakhs to a bank. So that is also an expense to this company, whereas this company is debt free. So if you deduct interest, what you're going to get is PBT, right? Profit before interest tax minus interest is going to give you profit before tax. So we have taken out interest also. So this is 50 lakhs because there is no debt. This company will be having a lower profit before tax of 40 lakhs because there is an interest expense. So we have deducted interest also. The next thing we have to do, we have to deduct the tax, assuming a tax rate of 30%. So 30 into 15 is 15. Here it is. Now you calculate profit after tax, you're going to get 35 and 28. So these two companies are performing equally well, right? But just because this company has got an interest of 10 lakhs, it has got a an interest of 28 lakhs. It has got a lower profit of 28 lakhs. Okay, but look at it carefully. You see, 10 lakhs is the interest expense. So technically, the profit should also have been lower by 10 lakhs. So this company, if it got a profit of 35 lakhs, the final profit after tax, this company maybe should have got a profit of 25 lakhs only, because it's got a interest expense of 10 lakhs. But it is getting something more, an additional 3 lakhs, and getting 28. So what is this 3 lakhs? From where it is coming? So this is known as tax shield. Okay. So interest provides what is known as tax shield. Okay. Interest provides what is known as a tax shield. It will be reducing the tax component to some extent. Right. So what we are basically doing in the above formula is we're adding back that profit. We're adding back that component. You see here in this example, interest is 10 lakhs. Right. Interest is 10 lakhs. To that we are 1 minus T, tax rate is 30%. So this is 70. Right. So this is totally 7 lakhs. Okay. So if you add back that 7 lakhs, to this 28, you're going to get 35. Okay. So what we are basically doing is, if any company has got an interest portion because it is having some debt, right, from banks or from outside parties, we are trying to add back that amount. Okay. And trying to calculate an equivalent profit had the company not taken debt. So what we are saying is we don't want the interest to affect the profitability, because interest is not an operational issue. You see, just because this company has taken interest, it's got a lower profit. But at an operational level, both these companies are same. So what we are trying to say is 28 lakhs is the profit of this company, fine. But what if this company had not taken the debt? Had it not taken the debt, it would have earned a higher profit. So we are trying to add back that component. So plus 7 will get you 35. So what is that 7? That 7 is nothing but interest times 1 minus tax rate. Okay, for this company is 10 into 1 minus tax rate is 30%. We are going to get that 7. Okay, so for every company we are going to do this. So that is how this formula is going to come. Okay, so return on invested capital is profit after tax plus interest times 1 minus T by invested capital. So this is the first ratio that I will advise you to calculate in any proposal, right? Even though your bank will not have this formula, right? Some banks do have a slightly modified version. They calculate, say, PAT by capital employed, right? PAT by capital employed. This is also a relatively a similar measure. So we are not adding back that second term here. So we are not adding back that interest into 1 minus T, that we are not adding. And then we are taking capital employed. Capital employed is net worth plus term liabilities. Whereas what we said, it is invested capital, net worth plus, it's not just term liabilities. So this term liabilities is long-term debt, okay? But what we're saying, it's not just long-term debt, but also short-term debt, right? So that modification is being done by some banks, and they're calculating PAT by capital employed. Okay, this is an alternative which you can calculate. If your bank stipulates this ratio to be calculated, you can go ahead with this. But in case your bank doesn't have this ratio, then you try to calculate the return on invested capital, right? You calculate return on invested capital, it will give you a fair idea to start with, right? So let us start with the major ratios, right? The first category of ratios we are going to look at is the profitability ratios. So there are a variety of profitabilities, there are a variety of measures to calculate profit. So if you recall our discussion we had earlier on profits, we started with sales, right? From this we deducted various expenses, right? If you remember, raw material, we had power, we had labor, we had repairs and maintenance, all of the direct expenses, right? Depreciation. So this is one part. So to this we have added opening work in progress minus closing work in progress. We get what is called cost of production. To this we add back opening stock of finished goods and closing stock of finished goods. We'll get cost of sales. From this we deduct selling and general expenses and interest, right? So we'll get what is known as operating profit. To this plus non-operating income minus non-operating expenses, you get what is known as profit before tax. Then tax, you get profit after tax. Okay, right? So this is the broad terminology. So there are various profit measures here, right? Profit after tax is the final figure. So this is one profit. Then before tax, right, there is something called profit before tax, right? Then there is something called operating profit, right? Even though it's not mentioned here, there is something called gross profit, right? So what is gross profit? the CMA data followed by banks doesn't have this item called gross profit, but basically it is sales minus cost of goods sold, right? So your cost of goods sold is something here. If you did a cost of goods sold from sales, you'll get what is known as gross profit. Okay. So there are various profit measures. Okay. So we are going to see what is the profit measure you should focus on. So even though there are various profits, the first profit you have to focus on is the gross profit. Okay. Gross profit is, okay, it is net profit minus cost of goods sold, right? So that's going to give you gross profit. That divided by sales is going to give you gross profit margin. Right? Sometimes gross profit is also measured as EBITDA, is also calculated profit before depreciation, interest and tax, right? That is, right? Sometimes this is also one way in which you're going to calculate, right? So then we have net profit. Net profit is net profit by net sales. Operating profit, whatever be the ratio, basically we take that in the numerator. If it is net profit, operating profit, and divided by net sales. Okay, that is how you're going to calculate profit. It's a very simple formula. In the denominator we'll be having always sales, and in the numerator we'll have the relevant profit measure, whether it is gross profit or net profit or operating profit or PBDIT, right? So the most important profit measure, if you are looking at comparison between different companies, is gross profit. Okay, gross profit is very relevant to the production department, right? Because after gross profit you're going to deduct some other expenses like general expenses, interest, tax, which are not really relevant to the operation performance of a company. If you want to compare two companies at the operational level, I'm saying not at the final, at the operational level, right? You should focus on gross profit. Let us see why. Take a look at these two companies. These two companies are having a turnover of same turnover, 10 crores. Profit before tax for these two companies, they're having the same turnover, right? Their expenses are same in every aspect. Every item is same. So till profit before tax, they are identical in all aspects. Then there is a tax component. So one company is having a higher tax, right? Other company is having a lower tax. So this company is paying a regular tax of 30%. This company, maybe it's located in a backward area. Maybe there's a concessional tax rate offered by the government. So this company is paying a lower tax. So based on that, this company is ending up having a higher profit. This company is having a lower profit only because of one item difference, that is the tax rate. Had you not considered tax rate, these two companies are operating exactly the same. It's only the tax amount that is making the difference. So now imagine if you are if you are a CEO of a group, these two are your group companies, and you now you want to reward the management of these two companies. Okay, so there's a management A, there's a management B. Both these companies belong to you. These are the single group, and you are the group chairman. You want to reward the management of A or B. You will not be making a correct decision if you end up giving more reward to B just because they have earned a higher profit. Yes, they have earned a higher profit, but if you really look at it, the operations are both one and the same. It is only the tax portion that has made the difference. And who made this decision? The taxation. It is just a government policy. But why was this company located as backward region? That decision was taken by you, right? You have taken the decision to locate this company at the backward region because you're going to get a concessional tax rate. It is you have made a decision, and then you went on to employ some person. You employed a managing director for this company. You employed a managing director for this company, and then from there they looking after the operations and earning the profit. So they earn 165 profit till this point is okay, but you can't attribute this portion, this higher profit, to better management style of B or better operational performance of B. You can't do that because that difference is only on the tax portion, and that decision was taken by you. You have decided to locate this unit at a backward region, and that's why it's got a concessional tax rate. So profit after tax is not a good measure if you're trying to compare the operational performance of two companies. Is that point clear? Right? So if you take out the tax part, both these companies are performing exactly similar. So should we then focus on PBT to compare two companies? Let us go one more step back. So now take a look at this table. So these two companies have earned operating income at the same level in all other aspects. Starting from turnover, every item is same, till the operating income it is same. Now this company has earned a higher non-operating income and thereby ended up having a higher profit. Okay, So now again, these are two different managements. You want to reward the management who has performed better. Are you going to say this company has performed better? Because operating income is same for both these companies. So why this company has earned higher income, higher profit? It's got something called non-operating income. So we discussed this item earlier when we were discussing the item-wise discussion on profit and loss account. Non-operating income is not a sustainable activity, right? Sometimes companies do get this one-time income. Say for example, profit on sale of fixed asset. This is not a everyday income, right? You're not going to rely on this. See, sometimes it happens that company will have a one-off income, just like that, right? But if you're going to rely on that income as a measure of performance, you're not going to do a great job. Basically, you want to compare at the operating profit level. Okay, it is possible that companies make operating loss and yet they report profit after tax positive figure based on some non-operating income. So let's not focus on non-operating income. This is something which we discussed earlier also. So if you want to compare two companies, so not only we have to delete the tax part, because tax is affected by the location, for example, government policies. We should also not take into account the non-operating income. Okay, so the point I'm trying to make is, say this company has got a very low profit, say 40 lakhs, whereas this company has got a profit of 165 lakhs, high profit. But maybe there is some non-operating income, say 200 lakhs, and suddenly you're going to have a high profit. This company doesn't have any non-operating income. So now you compare these two, you say this company is has earned a higher profit, so this is performing well. No, that is not performing well, right? Actually, it is performing very poorly compared to this at the operating profit level. So this non-operating income can boost profits, and it can be misleading. So if you want to compare two companies, deduct the tax part as we have already seen. Not only that, deduct also this non-operating expenses and non-operating income. So focus up to this part. But even then, we are making a small mistake here, because above that there is an item called interest, and again interest is not a really a measure of performance of the manager. So again we face the same problem. Look at this example. Both these companies, till the cost of goods sold, both are having 835 lakhs. Now again this company has got a interest component. So this will be this is not 855, this is a type error. This will be 815. This is an interest component, so it's got a lower interest, and all these figures will change. The point being that again you can't depend on interest, because till this point the companies are performing similarly. Now just because this company has got an interest expense, it has got a lower profit, you can't penalize this company saying you didn't perform well. So the point is basically you have to end up here. If you really want to compare any two companies, the comparison should end at this level. You should never consider expenses beyond this, because interest, your non-operating portion, income and expenses, your tax, these are not decisions taken by the management of the company, the operational managers. Let us put it that way. If you want to provide incentive to two managers who are production in charges, who are factory in charges, who are overseeing the factory, the production process, they are in charge of the labor, they are in charge of the production, the procurement, raw material, right? They are more involved in the direct cost aspect. Now if you want to measure the efficiency of these two persons at the production level, right, you have to stop here, right? It is precisely here where you have to stop, right? Because beyond that, interest, taxation, these are not relevant to the production managers. Okay, so if you want to measure, this is the point you have to keep in mind. If you want to measure the production efficiency, the operational efficiency of two companies, you should not consider items such as interest, tax, non-operating income, non-operating expenses. Okay, so what is the profit measure? So what is the profit measure we should be interested in? The profit measure we should be interested in is gross profit. So whenever if you want to measure the operational performance of a company, the profit you have to use is gross profit, because gross profit does not take into account interest, tax, non-operating income and other levels. So sometimes gross profit is also referred, as I told you earlier, PBDIT. So in CMA you have a slightly modified version of gross profit. I told you gross profit is sales minus cost of goods sold, but sometimes PBDIT is also used to calculate gross profit. This got a slightly different if you calculate PBDIT, that is to profit after tax, if you add back depreciation, add back interest, add back tax, you're going to get PBDIT, isn't it? This is what you calculate PBDIT. If you calculate this and you calculate this, there will be slight difference, but anyway it is a common practice to also use PBDIT in place of gross profit. So in fact, some as an international practice, the correct measure is, the measure that is used is actually EBITDA. Okay, earnings before interest, depreciation, tax, and amortization. Right? Usually companies will not have this. Right? Let us assume it doesn't have this. So basically we are seeing PBDIT. See, this is nothing but PBDIT. So PBDIT or EBITDA, whatever you call it, this is basically the measure you should focus on. So gross profit from now on, we are going to look at EBITDA. Okay, so that is gross profit. Okay, so now this gross profit can be compared. So this gross profit margin, right? This gross profit by sales. This you can compare between companies in the same industry, and you can also compare this bit for the same company in the previous year. So 2011, 12, 13. So right now the company is operating a gross profit margin of 10%, whereas in the earlier year it was earning 14%, 12%. So you're seeing the gross profit is declining. So you need to investigate why is it happening. Is it like the raw material cost is increasing beyond the control of the company? Is it unable to pass on the price hike to the customers? Is it unable to increase the sale price, or the power cost is going up? So you need to dig further. The basic point is you can compare two companies at the gross profit level. So once we focus on the gross profit, then we can go to something known as the operating profit. Right? Operating profit is also important because what it doesn't take into account is the non-operating income and non-operating expense. Right? So if a company is making operating loss, it is still possible to report a positive profit after tax by boosting non-operating income and non-operating expense. You have to be very careful regarding this. The first thing you should look into when you get a balance sheet in a P&L account is not the profit after tax. Right? It is not this. The first thing you have to look at is the operating profit. Because if this is negative and then the company is reporting a positive profit, that means something is happening in the non-operating income front. The company is artificially boosting the profit after tax to by manipulating the non-operating income, which is a one-time income. That is not an operating income. Okay. So first of all, always calculate the profit. Is the company making operating profit, right? Before net profit. When you give a P&L account, first focus on the operating profit. So those are the two important profit measures you have to focus on. First is the gross profit margin. Next is the operating profit margin, and then finally you can look at the PAT. Profit after tax is the final figure, but then you have to focus more on the gross profit, which measures the operational performance, and then the operating profit. Operating profit doesn't take into account the non-operating income and expenses, right? And then you can calculate PAT finally. PAT by sales will give you the grand overall profitability. That is also a measure which you can compare companies. You can compare to the previous year whether it's increasing or increasing. So those are the three profit measures you need to remember, right? Gross profit, operating profit, and net profit. So the next set of ratios we are going to look at focus on liquidity, right? So liquidity is the ability of the company to meet short-term obligations, right? To meet short-term obligations. So what are short-term obligations? These are obligations. These are financial obligations within the next, say, 1 year. For example, the company has procured raw material on credit, so it has to repay these raw material suppliers. Say credit period is 30 days or 45 days. So within the next 1 month or 2 months, the company has to pay to the raw material suppliers. So that is whether the company has got liquid cash to pay. That is a liquidity. Right here, it is like this. No, this is a common example that is given when you're trying to explain liquidity. This is an example which people give. So you got into a bus, right? The ticket is 5 rupees. Then you say you don't have 5 rupees, but you have a credit card. The credit card has got a limit of 1 lakh, right? You have gold, right? You got your traveler's check, worth some thousands. You got everything, but you don't have cash. So this is a liquidity problem. So your net worth might be huge. So you can have all this, but at that moment, at that point of time, all you need was 5 lakhs, and you don't have the liquid cash with you. A lot of people you might have come across this. They'll be having a lot of land, a lot of buildings in their names, real estate. But whereas when it comes to actual cash, they cannot even arrange 10 lakhs immediately. The buildings might be worth 1 crore or 2 crores. But on the moment, if you ask them, there is no liquid cash. This is what we're saying. See, these two are different, right? A person might have a very high net worth, right? Net worth is what? All their immovable property will also be calculated as part of net worth. So they might be having a lot of land and buildings. But what is the liquid cash? If today they want to arrange liquid funds immediately, can they arrange? We're looking at the liquidity problem here. Similarly, companies, the long-term viability of a company might be great. The company might be earning a lot of profits. It will repay the term loans of the company, of the bank. That is not a problem. But to meet the short-term obligations, immediate, there are companies which are really cash trapped. And it's not that the companies are bad. They don't have liquid cash. They'll be having a liquidity problem. We are going to calculate ratios that will indicate whether the company is having a sound liquidity position or not. That is what the liquidity ratios are going to do, right? So the most important ratio in a liquidity to measure liquidity is the current ratio. This is something which you already discussed under the chapter of chapter 8 working capital assessment. So please refer back to that chapter. We are not going to repeat current ratio. Current ratio, the appropriate place to discuss current ratio was in chapter 8. So we discussed that. So we discussed NWC and current ratio in chapter 8. So please refer back to those chapters. Right? We are not going to repeat it here. Basically what current ratio was is, current ratio is the ratio between current assets and current liabilities. So current assets by current liabilities, right? So it is a measure of, so how much of the current assets is being financed by the long-term funds. You want this ratio to be high, right? So academic textbooks prefer a ratio of 2.1 We also said why this is, right? So the logic is, even if the current assets were to fall by, the value of the current assets was somehow to fall by 50%, 100%, even then the company will be having the ability to meet the short-term obligations. That is the logic. But banks in general have a slightly different norms. 1.33 is the usual norm, right, for large projects. Sometimes 1.25, 1.15 depends on the category of the borrower. Sometimes SME borrowers will be having a lower stipulation, right? Again, you have to refer to your bank policy guidelines. So that is what current ratio is. Okay, the most important liquidity ratio is current ratio. Now current ratio has got a problem. One problem is, so what is current ratio? Current assets by current liabilities. And what are all including current assets? You have your cash, you have your debtors, you have your inventory, and inventory means everything, right? Raw material, work in progress, finished goods, everything, and then divided by current liabilities. So if you look at it, inventory can consist. We are not speaking of quality here. Okay, we are just saying inventory. What is the inventory? Closing inventory. We'll see from balance sheet and say this is so and so. But we're not really looking at the quality of this inventory. Now this inventory might consist of slow moving stock, obsolete stock, right? So in that case, the current ratio will be artificially higher, because you're not really taking into account the quality of the inventory. Similarly, debtors. These debtors, say for example, the company is having a credit period, is offering credit period of 45 days to its customers, but these debtors may be consisting of some parties who are not paying, who have not paid for more than 3 months or 4 months, long-standing debtors. So there's something problem with the collection procedure here, right? So those parties are not paying them. Okay, so is it fair to take those into account in calculation of current ratio, saying we have a high current ratio? Maybe if you deduct this and this obsolete stock, maybe this current ratio will come down drastically. We don't know. So current ratio has got a problem that we are not going to focus on the quality of this inventory and debtors. And also inventory takes time to convert, right? Even though it is a current asset, right? Even though it is a current, so that is one problem with current ratio you have to focus on. So to address that problem, at least to the extent of inventory, right? At least to the extent of inventory, there is a new ratio known as quick ratio. So this also current assets by current liabilities. So, but from current assets you deduct inventory, because inventory takes time, right, for conversion back into cash. Basically, we are interested in the cash cycle here, the operating cycle. How much time it is taking for cash to be injected into the system and coming back to us in a form of cash. So that is the operating cycle. Because this cycle is predominantly taken to a very large extent by inventory. So let us take out that inventory. So a new ratio was developed. So from current assets, you deduct the inventory and calculate current assets minus inventory by current liability. So you get what is known as a quick ratio, also known as a acid test ratio. This is also known as a acid test ratio. So this ratio ideally is preferred to be 1:1. At least it should be 1:1, greater than 1:1. Current ratio, we already discussed, it should be 1.33 depending on the bank guidelines. Acid test ratio, the benchmark is 1:1, right? So the significance of this ratio is, if a company has got acid test ratio of 1:1, right? Say for example, this numerator is 100 lakhs, denominator is say 90 lakhs. So what we are saying is, even though we are not considering inventory, so what is the current assets minus inventory? It consists of debtors and cash. So debtors is relatively better than inventory, in the sense that the process of sale has already been completed. We have already manufactured the product, we have sold the product, right? All that is left is realization. So in a way, it is less risky than inventory. So what this ratio tells us, in the next 1 year, I'm going to get 100 lakhs from my debtors, right? And I also have some liquid cash with me. So that put together is 100 lakhs. Say for example, 80 lakhs is my debtors. Okay, so debtors is 80 lakhs. I have cash in hand and bank on 20 lakhs. So these are very liquid because debtors I already made the sale. All that is required is I have to get back the cash. I'm confident of getting back this 80 lakhs. So this is 100 lakhs. Now my liability is only 90 lakhs. In the next 1 year I have to make I have to make payments to raw material suppliers, say for example to 90 lakhs. So this is a comfortable. I'm in a comfortable position in spite of not taking in inventory. Now inventory will also get converted into cash in the next 1 year. But in spite of not taking that, my ratio is above 1. So I'm in a comfortable position. So the benchmark for asset ratio is 1:1, right? Now there's one more ratio that is calculated under liquidity ratios, that is interval measure. So this is how you're going to calculate interval measures. It is current assets minus inventory, the same numerator we considered in quick ratio, divided by average daily operating expenses. What is this average daily operating expenses? So at an operational level, every day the company is going to incur some amount. So for procurement of raw material, to pay the wages, labor wages, daily operating expenses. So what this ratio tells us, say for example you are an employee, or somehow you lost your job, right? You lost your job and you're not going to get your salary. Okay. God forbid this has happened, right? You're not going to get any more salary. But even without that, you can survive for some days, right? Because you have some savings. Say for example, your savings is 2 lakhs. And let us assume that your monthly expenses, your house rent and every other expenses put together is some, say 20,000. Right? What this means is, right? For what this means is for 10 months, even though you're not going to get salary, you can survive for 10 months. If this is your operating expenses per month, 20,000, and you have got savings of 2 lakhs, for 10 months you can survive even without getting salary. This is what this ratio tells, interval measure, right? On an average, the company is having some operating expenses every month. Every daily is going to have some expenses. Say 10 lakhs. Every day is having some expenses. Power bill, right? Raw material, labor, all these expenses, operating expenses. Okay, and then current assets minus inventory is what the company is expecting to come, because this is, remember, current assets minus inventory is nothing but basically your debtors and cash, right? So the debtors means the sale has already happened. It's going to receive, even though no production takes place, right? Even though no production takes place, or even though no further sales happen from now on, because debtors is completed sales, I'm going to get some cash, right? So that cash and along with the cash in hand is going to survive my operating expenses for so many days. Say for example 20 days or 30 days. So for 20, so larger this period, I am more comfortable. It's a measure of liquidity, right? For 20-30 days, even though I don't do any further regional sales from now on, even though my production stops, even then I can meet my daily operating expenses, right, for the next so many days. So that's another liquidity measure which you can calculate. Okay. So average daily expenses, this is how we are going to calculate. So what is the average daily operating expenses? These are all the expenses. Okay. So cost of goods sold, excluding depreciation, selling, general expenses, because these are not the production expenses. Okay. This is general expenses. So you deduct the depreciation and general expenses from cost of goods. So you're going to get the average operating expenses for the year divided by 365 to get the operating expenses per day, right? So what that ratio tells you? So how many days the company's liquid assets can finance its operations, even if it doesn't receive any cash, right? Even if it doesn't receive any cash, even if there are no further sales, for how many days the company's liquid assets can finance the operations, right? Now there are a few other ratios which are not going to go in depth. For example, there's a cash ratio, there's an NWC ratio, right? There's various other ratios, but right, we're not going to go into them, right? If you're interested, you can refer any standard textbook on financial management. There will be a chapter on ratio analysis, because right, that will be providing you the required details. But the major ratios, what we have discussed so far, you have to be clear, right? So till now, whatever ratios we discussed, you please be clear, right? So under profitability, we discussed two categories, right? Profitability and liquidity ratios. So please be clear what we have discussed so far. So under profitability, we have discussed something known as gross profit, operating profit, and net profit, right? So under liquidity ratio, we calculated current ratio. We had something called quick ratio and interval measure. Right? If you are okay with this 6 measures so far, we are fine. Okay, till this point we are fine. Okay, so profitability measures and liquidity ratios we have discussed. So the next set of ratios we are going to focus is the leverage ratios. Okay, so these ratios indicate the extent of debt. Debt is the long-term debt. Okay, the debt is the long-term debt. Okay, the extent of debt used by the companies. So we have seen earlier that the companies can finance through a combination of your equity and debt, various combinations, say 10%, 90% or 20%, 80%. They can do a combination. Okay, subject to the bank policy guidelines, right? So why is this financing that mix? The pattern is why is this important? If you look at it, higher the debt, higher the risk for the lenders, right? Let's say for example a company has invested just 1 lakh its own capital. The promoters have got just pumped in only 1 lakh, whereas they're borrowing 100 lakhs from bank. This is a situation where as a banker you're not comfortable. We discussed something called margin. Okay, so we said that there should be a proportionate margin from the borrower side, because we need a borrower stake. Because something happens to this project and this project fails to take off, this borrower has got nothing to lose except 1 lakh. But whereas if his investment is say 15 or 20 lakhs, he'll be having a greater stake in the business, and he'll be more interested in surviving. He'll be more interested in keeping the project alive. Okay, so this is what we discussed on the margin. Okay, so basically these leverage ratios calculate the extent of debt. And common sense suggests that there should be some cutoff, beyond which as a bankers you should not be interested in extending finance to the company. Okay, say for example a company has got a capital of 10 lakhs. So as a banker, okay, you can extend up to say 40 lakhs or 50 lakhs. You're comfortable. 100 lakhs, 200 lakhs, 1000 lakhs. At some point, you're going to say enough is enough. You're not going to extend beyond this stage unless you get in your additional capital. Basically that is what we are going to calculate in these leverage ratios. So the extent of debt. So leverage ratios calculate the extent of debt, and it's important to bankers when we are financing term loans, right? When we are financing CC, liquidity ratios are important. Right, as a lender of working capital finance, if you're sanctioned CC or OD to a company, you are more interested in the short-term liquidity position of a company. So there we calculate current ratio, asset ratio, right? Those ratios we calculate. But if you're a long-term lender, if you're a bank of extended term loans, now we are more interested in the financing pattern of this company. Is the borrower bringing in his proportionate margin, or is he entirely surviving by outside funds? Outside funds doesn't mean just banks. Okay. So banks are there, creditors are there. There could be other short-term borrowings from outside parties. So all this put together, all this put together is 100 lakhs, whereas this party has got bought only 5 lakhs. So 20 times. Now you get the feeling that this is not correct. He's not bringing so much margin, whereas he's entirely doing the businesses outside funds. You should never allow this to happen. So what is this 20? So 20 times of his capital, the total outside borrowings are there. So is there a benchmark like saying so many times is the maximum we can give, right? 10 times or 5 times, is there a norm? So that is what we are going to discuss. So the first ratio we are going to discuss here is the debt equity ratio. Debt equity ratio is simply long-term debt by tangible net worth. So tangible net worth, take it as a promoter's margin. So we'll be having the share capital plus the reserves and surplus. This is a total contribution by the promoters. So say for example this is 5 lakhs, and say that long-term debt is 10 lakhs. So then we'll get a debt equity ratio of 2:1. So what this ratio tells is how many times the company has got outside long-term debt compared to its own contribution. And contribution includes not just capital, also reserves and surplus. Okay. So compared to the promoter's contribution, promoter's funds, how many times is this company borrowing long-term debt? Okay, not short-term debt. We don't add short-term debt here. It's a long-term debt. Okay. So that is what debt equity ratio tells. Debt equity ratio tells us normally banks will be having norms say 2:1 or 3:1. 2.5:1. No, it will depend on the banks. Okay, so if it's a project, say for example a 100 crores project, right, and the bank has got a norm of saying say 2:1. So what it means is we'll sanction at the most 67 crores. You bring in 33 crores. In that case, your debt equity ratio will be 2:1. This is the maximum you're going to finance, 67 crores. If the policy says net equity ratio is 2:1. Some banks may be having a ratio of 3:1. Then they'll say we'll sanction up to 75 crores. You bring in 25 crores. So 75 by 25, 3:1. So that will depend on the bank. So debt equity ratio is that. Okay. Then there is another ratio called TOL by TNW. This is also very commonly used ratio in banks. Same ratio. So here we didn't calculate current liabilities, did we? This is only term liabilities, long-term debt. Okay. But if we also consider current liabilities, then we get a ratio called as TOL by TNW. Denominator is same, TNW. In the numerator, we will consider both term liabilities and current liabilities. Here we consider only term liabilities. Okay, that is the difference. So what is current liabilities? So it includes your bank CC, your creditors, right? Your creditors, your advance from customers, all these short-term liabilities will be coming in TOL by TNW. So this again varies from bank to bank. Say for example 5:1 or 6:1. Right? It depends on the bank to bank. Some banks might be having 4:1. Right? It depends on bank to bank. So what it means? Say for example, a company is having term liabilities, all term liabilities put together, say 20 lakhs. Okay. Then there is a CC of 10 lakhs. Creditors are say 5 lakhs. Okay. So all put together you have 35 lakhs. Now the net worth of this company, right? Say for example it is 7 lakhs. So what is TOL by TNW? TOL by is total outside liabilities, including both short term and long term. All this put together, 35 by TNW 7 lakhs. So this is 5:1. This company is having 5:1. Say the bank's policy is 4:1. It is saying we will not finance to a company who's having TOL by TNW greater than 4:1. Then what should the company do? If this is 5:1, then the company has to bring in additional margin. Say this 7 is increased. Say they got additional capital of 3 lakhs. So this, if they increase this to 10 lakhs, then it will be 35 by 10. It will be 3.5. Right? So if the TOL by TNW is not as per the bank's norm, what they should do? They should increase their margin. So in that way, the TOL by TNW will come down to the bank's norm. Okay. So this is a common condition stipulated by banks. Okay. If you while analyzing a balance sheet of a company, you find that TOL by TNW is not as per your norm. It is greater than 4:1 or 5:1 as per the bank's norm. What do you do as per the bank's norm? What do you do? You stipulate a condition saying you bring in your long-term funds, your margin. Yeah. Sometimes banks also consider unsecured loans to be a part of net worth. So either your unsecured loans or your capital you bring in so that your TOL by TNW will improve and come down to bank's norm of 5:1 or 4:1. Okay. So say for example this is the position of a company. The company has got term liabilities of 10 crores. It's entirely bank loan. Okay. And then there is current liabilities and TOL by TNW we calculated 6. TOL by TNW is TOL is both term and current liabilities 1800 by your net worth. So you got 6:1. Say the bank norm is also 6:1. So it is complied with 2013 audited balance sheet. The company is TOL by TNW is as per the bank norms. Now for this year the company has come to you seeking we want to purchase a machine costing 10 crores. You please sanction as a loan of 5 crores. We'll bring the balance 5 crores from our own funds. Right, 50 lakhs from our capital and 450 lakhs from unsecured loans. That is what the company is proposing. Right. So are you going to sanction to this company or not as a banker? So because your norm is 6:1, let us see what happens if you take up this proposal. So if you take up this proposal, so this is what is going to happen. Okay. So additional 500 lakhs, unsecured loans 450 lakhs, total 950 lakhs is the additional term liabilities. Right. So total for the next year it will be 1950 term liabilities. Current liabilities, let us assume it is same. Net worth 50 lakhs, additional capital 350. Now you are calculating, you're going to get a TOL by TNW of 7. It's actually 1500 by 300. Okay, so 5:1. I think earlier we calculated is 1800 by 300. Okay, so that is not 6:1. It's 5:1. Bank norm is 6:1. So existing is 5:1 is as per the bank norm. But now because the bank norm is 6:1 and the proposed financing pattern is like this, it is 7:1, and this is more than the bank norm is 6:1. So now what bank can say? Okay, this is not acceptable to us. Right? You try to improve your margin. Instead of 50 lakhs, you try to bring 1 lakh or 1 crore or 2 crores, and then maybe the margin will the ratio will improve, and then we'll take up the finance. Okay, that is what bank can do. Okay, so TOL by TNW. So whenever you're getting a proposal, you need to look at the projected TOL by TNW, right? So the existing TOL by TNW can be as per the bank norm, but then if the proposed financing pattern is taken into account and then the ratio is not as per the bank norms, you should object, right? Then you should say you bring in more capital, right? So you have to calculate the projected TOL by TNW also. Okay. Sometimes banks do consider unsecured loans also as part of net worth. Sometimes they consider the entire unsecured loans as part of net worth. Sometimes they consider only 50%. So you have to refer your bank policy guidelines. So if that is the case in the earlier example, I think even if you consider 50% as unsecured loans, the ratio will improve. So that calculation will be like this. So if you take it, so early existing is 1500 lakhs. Term loan, let us assume no repayment is 1500 lakhs. Unsecured loans originated was 450. Now 225 lakhs. So if you do the reworking, earlier we got 7:1, okay, and we said this is not as per the bank norm. But now if the bank is allowing 50% of the unsecured loans to be taken as part of net worth, So 450 lakhs is the total unsecured loans. Okay. So now bank is saying we'll take 225 lakhs as part of net worth. Instead of taking 450 entirely as term liabilities, we'll take 225 as part of net worth, and remaining 225 only we are going to consider as term liabilities. Then the reworking will be like this. So instead of 450 lakhs unsecured loans, we'll show only 225, and in net worth we'll add back the 225. Right. So if you do the calculation, you'll get a TOL by TNW of 3.87. This is now as per the bank norm. Right. So this financing pattern bank can accept. Right. Because it is below its norm of 5:1. Right. So these sort of calculations you need to be thorough with. Now a ratio that is very similar to TOL by TNW is something known as gearing ratio. This is calculated only for non-fund limits. The formula is exactly the same, right? TOL by TNW. So TOL is term liabilities by current liabilities by net worth. Everything is same, but to the current liabilities you also add back the non-fund limits. This is applicable only for the companies having non-fund limits like LC and BG. So in that case we calculate the gearing ratio, right? So from net worth you can deduct. You have to deduct the non-current assets and investments in sister companies. Okay. So because technically these are not part of net worth. Okay. Sometimes what banks do is also stocks procured under LC can be deducted from these current liabilities, because otherwise you end up deducting that twice. Okay. That is an advanced issue, but you can basically follow this formula, right? But if you understand why we're doing this, if you have the information on LC creditors, that you can deduct from current liabilities and then go ahead with adding back the non-fund limits, right? That you can do, right? It's only if you understand that point. Okay. Slightly advanced. But anyway, the TL by TNW, just like TL by TNW, gearing ratio will be also having a norm. For example, say 10. So if a company is applying for non-fund limits and the gearing ratio is below 10, you can go ahead with the finance. If it is above 10, maybe you have to again insist on additional margin. So another ratio which banks calculate is interest coverage ratio. Interest coverage ratio is PBIT by interest expense. Usually the norm is around 2. You know, a 2 is normally insisted on. What it basically tells you is the interest serving ability of the company. If you remember, when we discussed about term loan appraisal, we calculated a ratio called DSCR. DSCR will tell you about the total repayment ability of the company. It includes both installments and interest. Whereas this interest coverage ratio focuses only on the interest part. So compared to interest, how many times is your PBIT? Okay. So say for example, your interest every year the company has to pay 2 lakhs interest. It's got a PBIT, say for example 10 lakhs. So 5 times coverage. Okay, it's comfortable. That's how. Okay. So far what we have discussed, please recall, under profitability margins, under profitability ratios, we have calculated operating profit, we have calculated gross profit, operating profit and net profit. Okay, these are the 3 things we have calculated. So we also discussed something called liquidity ratios. So under liquidity ratios we calculated current ratio, quick ratio and interval measure. Is it interval measure? Okay, and then we calculated leverage ratios, right? And then we had a discussion on leverage ratios. Under leverage ratios we calculated debt equity ratio, TOL by TNW, gearing ratio, right? And finally we calculated interest coverage ratio. Okay, so please be comfortable with the ratios we calculated so far. Next we'll proceed to turnover ratios. So turnover ratios is something which we discussed earlier when discussing about working capital assessment. If you recall how we calculated the holding levels, right? So 2 months stock of raw material. So if you recall that segment, this will be very easy. So these are the formulas we discussed last time, right? So the raw material stock level is consumption per month into holding levels in month. Pretty simple, right? So how much raw material the company should be having in its godown? Say for example, every month the company is consuming 20 tons, and it wants a buffer stock of say 2 months, right? What it means is, even if the raw material, if for some reason the raw material is not arriving at the plant because the supplier is not supplying due to various reasons, so for 2 months the company can go ahead with its production even though raw material is not arriving, right? If it has 40 tons of raw material in the godown, right? If it has 40 tons of raw material in the godown, first month it will draw 20 tons, second month it will draw 20 tons. So for 2 months it can survive even though there is no supply of raw material. So this is known as holding level. 2 months is the holding level. Okay, so how we calculate this 40? So how we got this 2 months? Very simple. 2 months is stock. What is the stock we have? And then per month how much you have. Stock in this example was 40 tons, right? Per month we are using 20 tons, so 2 months. So stock by per month. So now if you want the raw material stock level, you just flip the formula. So if you want the stock, it is holding level into consumption per month into 2, isn't it? See, per month consumption per month into holding level. So all formulas basically same. Okay, this is cost of production into holding levels in month will give you work in progress level. Cost of sales into holding level will give you finished goods, right? Sales into credit period we are giving to our customers, that will be receivables, right? And creditors will be raw material consumption into credit period in months. This is the credit that suppliers are giving to us. So these are the ratios you already calculated before, right? So this is the calculations we already done before. So please be comfortable with this. If not, please refer back to the previous segment. So when calculating turnover ratios, what we do is, we just flip these ratios using this same formula. What we do is we have to just flip it. Say for example, receivables. We have receivables is sales per month into credit per month. So if you want a ratio called debtor realization, right? This is what we want. Then you just calculate receivables by sales per month. Simple formula, right? Just bring it this side. Receivables by sales per month will be credit period in months. Okay, so that is a ratio. That is a turnover ratio. So you can have various ratios. So right, raw material holding level, okay, work in progress level, finished goods level, debtors realization period, and creditors period. So all these ratios you can calculate accordingly. Okay, so for example, you want raw material holding level, what you do? You calculate the closing stock of raw material divided by raw material consumption per month. Right? Simple. Okay, basically this is how you're going to calculate. Okay, so if you want the turnover, right, if you want the turnover, this is what you're going to do. There's going to be a slight flip. You have to just flip the ratio, right? So what you calculate as a holding level? Holding level is, we said, what is the closing stock of raw material divided by per month. Per month, what is the consumption, right? Say for example, the closing stock is 40 lakhs. Every month consumption is 20 lakhs. Holding level is 2 months. Okay, right? So if you want to calculate the turnover, what it means is, in 1 year how many times this is rotating, right? Just 12 by 2 is going to give you the turnover, raw material turnover. 12 by 2 means 2 months. Just do this simple calculation. Say for example, you want the debtors turnover. Earlier we calculated debtors by sales per month. Okay, now we flip it, sales by debtors. But this is sales for the entire year. Okay, this is per month, this is entire year. So what this turnover ratios is going to tell us basically is the rotation. Okay, say for example, your sales per year is 12 crores. Okay, average debtors is 120 lakhs. What it basically tells is, your debtors you're able to rotate your debtors 10 times in a year. The debtor cycle is 10 times. You want this cycle to be very high. You want the turnover to be high. You want this turnover ratios to be high. What it basically tells is, you're rotating your inventory very fast. Say for example, this ratio is very low. Your finished goods is at 2. Basically what it means is, for 6 months is taking you 6 months for the finished goods cycle to complete. You don't want that sort of situation. Okay, you want a fast moving company, a company which is doing brisk business, wants its turnover to be very high. Turnover doesn't mean here sales. Okay, what turnover here implies the speed of rotation, right? You want your cycle to be very fast. You want to purchase raw material, you want to quickly convert them into finished goods, you want to quickly dispose them off, you want to quickly sell them, quickly get back the cash from the debtors, and start the cycle again. You want the rotation to be that quick. In every year, say for example, you're doing this rotation 6 times or 8 times, 10 times. This means your cycle is very fast. That is what the turnover ratio. Otherwise, if you have a dull business, you have a turnover of 2 times or 3 times, it's going to take you 4 months, 6 months. That means your business is not that brisk. Okay, you want this rotation to be very fast. That is what your turnover ratios are going to calculate. Okay, then there are some other turnover ratios: current assets, fixed assets, total assets. Basically it means sales by whatever you want. For example, fixed asset turnover, sales by fixed assets. Okay, these are ratios you're not going to discuss, right? If you're interested, you can refer any textbook on financial management. But fixed assets turnover is something which we can focus on a bit, because this is something banks do calculate, right? Other ratios not that much. But fixed assets turnover, basically it means is, for every 1 rupee investment in my fixed assets, how much sales I'm generating, right? Say for example, a company has got the fixed assets of 1 crore and is generating sales of 2 crores. Whereas another company with the same 1 crore investment in fixed assets is generating sales of 10 crores. So obviously what we are saying is, this company is more efficient in utilizing its fixed assets. So for every 1 rupee investment in fixed assets, how much sales I am generating, that is fixed assets turnover. This is a ratio which is calculated by banks, right? So this you can track down. So whenever a company is making large purchases in the fixed assets front, right, is make major purchases on property, plant and equipment, okay, PPE. So whenever a company is making this large sort of purchases, you can follow this ratio in the subsequent years to see how effective this investment was, right? So before the purchase of that fixed asset, that large machinery, maybe the turnover is say 3 times, okay. Now after that, you definitely want this to improve, okay, at least to 4 or 5. Now if it is at the same level around 3.25, so this is not contributing in any way to your increase in fixed assets turnover. So that is one ratio you can keep track of when there is investment in purchases of the fixed assets, purchase of fixed assets. Then finally, we can look at capital market ratios. Again, these are ratios that are usually tracked by analysts in the tracking the share market. As bankers, you don't usually look at these ratios, but there are a couple of interesting ratios, but a couple of important ratios which you are interested. That is EPS and P&D. EPS is earning per share. So if a company is a private limited company, so if a company is a limited company, this is not applicable for proprietorship and partnership forms. But if the company is a limited company, then you can calculate EPS. EPS is nothing but your profits by total outstanding shares. So for per share, how much is the earning, right? That is EPS. So this is EPS, profit after tax by number of shares. Okay. So it tells us the profitability on a single share basis. So then you can compare this with other companies in this industry. P ratio, it is basically a capital market ratio. It's basically tracked very much by analysts. Okay. Maybe as a banker, you're not that interested, but P ratio basically tells you about the expectation, the market expectation. See, theoretically, theoretically this should be 1. See, if a company is earning on a per share basis, say 20 rupees, right? The market value should also be 20, theoretically, right? Theoretically, this should be 1, but then if this is 5 times or 10 times, so what this basically tells you is, what is the market's outlook on this share? If the market expectation is very good on this share, the market is expecting this company share will increase in the future because they feel this company is worth a lot more than its current market price. Maybe they feel that way. So they're expecting this to move up. So then this P ratio will be more than 1. So P ratio of 5 or 10. Basically the market is expecting the share to go up. So P ratios you can compare between 2 companies. Right? Again, this is not something which you are not, as a banker, you're not that interested. But then a company which has got a large presence in the capital market, maybe you can track this ratio, right? Then there is a dividend payout ratio, right? It is simply dividend by profit after tax. So how much out of the profit earned, how much is the company declaring as dividend? Okay. There is a condition usually that company should not declare dividend without the approval of the bankers, which is rarely followed. But anyway, this is a ratio. This is also a ratio which banks do keep track of. Okay. So if you want to wrap up this chapter, the most important thing that you have to know is all these formulas you're not going to calculate manually. See, none of these formulas you're going to calculate manually because all banks will be having some Excel-based spreadsheets, Excel-based templates. There'll be a blank format. You just enter the basic data, the P&L balance sheet, and every ratio is calculated. You basically need not calculate anything. All the ratios we discussed so far, the current ratios, your debt equity ratio, interest coverage, everything, current ratio, TL by TNW, everything will be coming in automatically. You need not do anything. But then the point you have to remember is the entry part. The input to this Excel template will be the P&L balance sheet. When you enter the P&L balance sheet figures, you have to do the classification correctly. See, once you do the input and once you calculate these ratios, the ratios are calculated automatically, and you include these ratios in your process note, and that note goes to your management, top management. They won't be calculating again. They won't be taking a calculator and calculating the ratio. So you calculate the current ratio of 1.40. Your bank norm is 1.33. So management will be, so the person above you who will be reviewing this note basically saying, okay, this current ratio is as per the norm. Again, they won't take a calculator and decalculate this, because this is basically driven by the formula. So current assets by current liabilities. So you got the ratio is 1.4. You didn't calculate this manually, so this is okay. But the point is, did you classify it correctly? Are there some items that are non-current in nature which you put in current ratio, current assets? Say for example, there is a investment in group company. So this is actually should to be classified as non-current asset, but by mistake you have put it in current assets, and thereby the current ratio is 1.4. Had you not done that mistake, maybe current ratio would be 1.2 and it is less than 1.33, right? So if you do these sort of mistakes, so based on this, maybe the sanctioning authority can take a wrong decision, right? One, the decision may be wrong from a sanction point of view. 2, the powers might be violated. Maybe this person doesn't have the powers to sanction loans who have got a deviation current ratio. So you have to be careful on that front, not the calculation. See, the Excel template will give you throughout the ratios. will throw the ratios at you. So you need not be worried about that. But the input, the input that goes into Excel sheet, what you input in the P&L and balance sheet account, that classification, whether it's a current asset or a non-current asset, whether it is a short-term liability or a long-term liability, that classification you have to do correctly. Okay. Based on that, automatically the ratios will be coming up. Okay. So with this, we come to the end of this chapter, right? So in the next chapters, what we'll do is we'll take up case studies and try from scratch. Okay. So if you're given a balance sheet and a P&L account, how you're going to start from scratch? Where are you going to start? And what are the ratios you're going to calculate? How are you basically going to approach a financial analysis? That we'll be discussing in the coming chapters. Right? See you then.